Hi, welcome to the second podcast where I'm going to be looking at ratios. This time I'm going to be looking at liquidity ratios. What's liquidity? Really quickly. Liquidity is generally related to the speed with which money flows through a business and the fact that there's always going to be some money coming in and sufficient quantities to meet the money that needs to go out to pay things like banks or to pay the suppliers of the business. Obviously, if you can't pay your suppliers in the short term, you have a big problem. They won't supply you with any goods. They are likely to take you to court, and it's highly likely that your business will be liquidated. 70% over 70% of businesses that do go into bankruptcy actually have made a profit in the last full year of trading. The problem's been that they've simply run out of money. Now, some of that's because something's gone wrong within the business. Maybe a big customer has also gone bankrupt, which quite often happens. The customer goes bankrupt, is unable to pay the supplier. That supplier is unable to pay another supplier. So they may well have been trading profitably, but if you don't get paid for the money that you actually are owed by your customers, obviously that's a very bad situation to be in because you still have to pay your suppliers and you can't get the money off a bankrupt customer. We've got five real ratios to look at here. Six even, sorry, I'm lying to you. We've got the current ratio, we've got the quick ratio, trade receivables collection period, trade payables payment period, and down here we've got two ratios to do with inventory turnover. This average inventory isn't really a ratio, it's something you need to do to calculate these two. Your average inventory is obviously your opening inventory, which comes from your it's got to come from the income statement, and then you could have taken the closing inventory from either the income statement or the statement of financial position and then divided it by 2. And then these two ratios, I had to put both of them in because the specification I teach has at times in the last couple of years asked you specifically to use one of these two ratios. They're actually the same ratio, they mean roughly the same thing, but what you'll notice is that this one is given in terms of times, and it's costs of goods sold or cost of sales over average inventory, or this version of the ratio is average inventory divided by cost of goods sold and then times by 365. This one is given in terms of time. So the first one, that means that 9.7 times during the year a piece of inventory has been bought, sold and replaced and then bought and sold again. This one means that on average every 37 days, which becomes 9.7 times, that a company buys some goods and it would expect to sell them after 37 days. So that one might be confusing. As with last time, going through, doing the calculations of the inventory of the ratios, I've got the same statements of financial position and income statement here that I've used for doing these ratios as well. Most of the information for these types of ratios comes from the statement of financial position. You will find some of the information coming from the income statement. Okay, first one's a basic liquidity test. Current assets, that's what we think we're going to turn into cash. So at the moment, this business thinks they're going to turn $22,000 into cash in the short term, and their current liabilities are only $10,000. So the current assets are a lot more than the current liabilities. The working capital is $12,000, and therefore they have a ratio, and this time it's expressed as a ratio of 2.2 to 1. Probably a little bit on the high side, but we'll talk about why that's the case in a few moments. Quick ratio is a similar type of calculation, but here we just use, in this case, the trade receivables and the cash and cash equivalents. We ignore inventory. So you can either think about it as being current assets minus inventory, all over the current liabilities, or you could just add together the remaining current assets. Either way, it comes to 1.4 to 1. Trade receivables collection period, that's calculated by using the trade receivables, which are 12,000 up here. Okay, we then divide that by credit sales, and be careful on this because you'll often be told what the credit sales are. They're 90% of all of sales. So what I've done is I've done 90% times 120,000, and that comes to 40.56. And theoretically, we could write 40.56 days, But what the general convention is to write it in terms of the day it is received. So it's not received on the 40th day, it's actually received during the 41st day. So although you will occasionally, some of the exam boards are quite happy for it to be written as 40.56 days. Okay, what you should really do in theory, and the exam board that I work for teach, certainly for GCSE, they go for 41 days, so the next whole number of days. Right, just to break it up a little bit, what do these ratios mean? Well, remember I said on the first video, some of the ratios are a little bit more complicated. They're not always good if they're big or good if they're small. These ratios tend to be like that. So the first thing is, the simple thing is, what does a current ratio show? Well, in this case, it shows that this business has got $2.20 of current assets to turn into cash to meet every $1 that's of liability that's due. So that sounds quite good, because it does sound like they're going to be able to pay the people they borrowed the money off. This ratio has increased, so a bit like we did last time. Do talk about any increases or decreases. It's increased in the previous year by $20, 20 cents. That may be a good thing for the business, because it's got more cash that's going to be coming in to pay those liabilities. Probably in this case, it probably isn't a good thing, because having lots of inventory or having lots of people owing you money, once you've got lots and lots of it, you'd be better off actually getting that money in. If you run a chain of shops, maybe opening a new shop. If you run a factory, maybe trying to get more equipment so that you can sell elsewhere. So after a certain point, having too much current assets compared to your current liabilities actually means you are not managing your business efficiently. You could free up some cash and go and buy something useful. So in this case, I think probably it's going to be on the high side. For most types of businesses, people normally think the ratio should be somewhere between about 1.5 to 1 and 2 to 1. Okay, but it really very much depends on the industry. There are some industries where 2.2 to 1 would be ideal. Supermarkets, an awful lot lower than that, because they sell goods very quickly for cash. Quick ratio, so very similar explanation. Shows the business is $1.40 of assets for every $1 of current liabilities. It's not changed from the previous year, so that makes it very, very easy to make the comment about it. I've written up change there, so I just need to go and change that to an N. Okay. Again, probably there is too much money invested in the current assets for this business, but we don't know for certain. We don't know the industry. It used to be always said that that ratio should be somewhere between 0.8 to 1 and 1.2 to 1. And again, if it's lower than the business, other firms in the same industry, it could mean that the business is going to have problems in the long term generating cash to fund those liabilities. And the reason why we have the two ratios, inventory is the hardest asset for most businesses to turn into cash. So because you've got to turn it from cash into trade receivables, and then once it's a trade receivable, you've got to generate the cash from the customer. So that ratio is considered to be, if you like, an improved version of the current ratio. Trade receivable collection period, 41 days. That means it takes 41 days from completing a sale to actually collecting the money. That's actually quite a long time for most businesses. Most businesses try and work on around about 30 days. But for example, somebody selling to supermarkets may insist that they have a 90-day collection period. Certainly in this case, it's fallen by 19 days from the previous year. So if we look up here very quickly, it was 60 days last year. So that's probably a positive for the business. And in general, the business will try to keep it less than 30 if they possibly can. And that's because it's a good thing to, once you've sold the goods, to get the money in as quickly as possible. The longer you allow people before they pay you, the more chance there is that that business will go bankrupt and you will never collect your money. But there is a downside to this ratio being particularly low, and that is that firms like to get a reasonable amount of credit so they can have standard chance of selling those goods on to the end customer and collecting their money. So if the figure is relatively high, relatively low, sorry, that may mean you do lose customers to other businesses offering easier credit terms. Last two to have a look at. We've got the trade payables payment period, very, very similar to trade receivable collection period. Be careful again. Okay, first of all, this time we use the purchases, not the cost of sales. Okay, so that's important. Remember to use purchases, and it's only credit purchases. So in this case, it's only 90% of the 35,000. So we do the 6,000, which is the trade payables at the end of the year. Divide that by the credit purchases. We've discussed that already. While we times it by 0.9, times it by 365 because it's the number of days we're after, and it comes to 69.52 days. But again, we're going to round it up to 70 days because we don't actually pay people on 69.52 days. We pay them during the 70th day. And again, write it out this way, make it clear to the examiner you've calculated both the fraction, the decimal, and then also deliberately rounded it up to the number of days. Inventory turnover. Okay, we discussed this a little bit at the start. Cost of goods sold. So again, we're going back here to this figure now, not to the purchases figure. And the first one, we will divide that by the average inventory. Average inventory is opening plus closing inventory divided by 2. And we write it, if we're doing the formula this way, as 3.7 times. So we use a decimal, ideally do it to 2 decimal places. That means that the goods for this business change 3.7 times during the year. Doing the formula the other way, 9,000 divided by 37,000 times 365 comes to 88.78 days, rounding up to 89 days, because on the 89th day on average we are selling our inventory. And what you'll find is if you multiply 89 by 3 or 88.78 by 3.7, it will come to a whole year. So the formula is coming from the same place. And trade payable collection period. Okay, generally we'd like that to be a relatively long time, because what we want to do is to be able to collect the money off our customers first before we have to pay our suppliers. Certainly here it's increased by 20 days, but 70 days, to be honest, is probably a little bit on the long side. And in this case, it's probably actually a little bit of a bad thing, because the suppliers won't be happy to have to wait 70 days to get their money back. What they may do is start to actually refuse to supply this business with goods. If the suppliers are paid too quickly, obviously the money is going out of the business too quickly, and that means there's more chance of businesses going to run out of cash. But probably here, I don't think that's going to be the case, to be honest. I think here 70 days is probably on the long side. And for the inventory turnover, again, very industry specific as to what there is. So ideally be comparing with similar industries. Over 89 days is very, very long for most industries. Something like a supermarket like Tesco's or the Sultan Centre in Kuwait, they'd be looking maybe at 3 or 4 days as being their inventory turnover for things like bread, fruit, etc. 89 days is very, very long. But for somebody making, for example, ships, big ships, container ships, then 89 days may be a very, very small inventory turnover, because obviously it takes a long time to complete that building process for a big ship. But certainly for most industries, it's very high. You've got a lot of storage costs attached to it. There's more chance that goods will get damaged if you've got more goods in the storeroom. You have to pay more insurance costs because you've got a higher value of goods on the premises, and there's more chance goods will also become out of date. So generally, a figure of 89 days would be too high. There is a danger if the figure gets too low that firms run out of stock. And if you run out of stock, customers go elsewhere, and then you've got to win them back. Right. got your examples to do. I want you to also write what you think about the actual ratios. So write something very, very similar to what I've done for each of the ratios. And then a little bit of theory just to cover off at the end. So there's your questions. I need to add in an extra couple of figures there, so I'll finish that off in a minute. So final thing we need to cover very quickly, problems with using ratios. This is a very generic, very common exam question at both IGCSE, UK A level and international A level. Problems with using ratios, you really need to compare with businesses in the same trade. So you can't compare, if I was looking at Coca-Cola and Toyota cars, I couldn't really compare those businesses using ratios. They should also be of a similar size and with the same amount of money invested in them. So it's very hard to compare a small corner shop with a supermarket. Ideally, it should be the same type of business, so you should compare a sole trader with another sole trader, limited company. Very difficult to see a trend if you're looking just at 1 year's worth of information. So if I just do the accounts for 2012, I don't know what happened before that, so I don't know if this company's improving. I don't know if it's getting worse, and therefore I don't know what the trend is. You obviously, so thinking back to 2007 when we had the financial crisis, you may be looking at the information from a year that isn't typical for that business. A business has one massive sale to as a one-off to a new company, then that will completely change the way those accounts look, and therefore we may be looking at something that isn't really normal for that business. Year ends at different dates. That particularly applies to, for example, in the UK where we have Christmas. If a UK retailer has a year end at the end of September when they've got all their inventory in for Christmas, where some retailers do up to 90% of their sales for the year, then they will have a much higher average inventory and therefore would appear to be a much lower inventory turnover than a business that did their year end at the end of January after those Christmas sales. Firms operate different accounting policies, so to some extent they can do something called window dressing. They can have different rates of depreciation, and so although eventually it ends up with the same answer, they will have more profit if they are doing, for example, straight line and have bought a lot of assets in a particular year. Statements don't show non-monetary factors, so things like how good the management is. Probably in the long term, that's not an issue because good managers generate good profit. But in the short term, if you've just changed your management, it may look like the business is doing poorly, but they've actually got in some fantastic new managers. And quite often, it's possible to obtain all the information to compare with another business. And the reason for that is because other businesses don't have to give the information out unless they are limited companies. Right, make sure you get the questions done. Make sure you get the questions back to me. Good luck with all that. I know it's a bit of a long one, and hopefully you found it useful.